I'll read the first paragraph, and I would appreciate if you could read the rest before we continue on with the webinar. Trading the financial markets may result in the loss of your deposited funds. Please ensure that you fully understand the risks and seek advice, independent advice, if necessary. Now, ETX is a fast-growing financial services company. We are regulated by the FCA, and we have a broad global client base. And our parent company, Monacore London, is a member firm of the London Stock Exchange. Now, tonight's class is being recorded, and if you'd like to see a recorded version of this class, in about 24 hours, you can use the same link you used to come to tonight's class to see a recorded version of this class. So let's get started talking about technical analysis for CFD, Forex, and crypto trading. Now, tonight, I'm going to use the term security when referring to any tradable financial instrument. This includes stocks, bonds, commodities, futures, indices, mutual funds, options, and of course, CFDs. While I may imply a specific investment product, like I may say shares, or I may say stocks, or I may say crypto or Bitcoin, or maybe I'll say the euro, or I'll say Forex. But when we do this, it's just using a general term. But the concept that we're talking about works for all investments that are publicly traded financial instruments in an open marketplace. It just gets very boring saying security, 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 security. So, it's just understand we're talking about everything. Similarly, I will intermix the term investing and trading. Now, since we're all here from ETX, we are by definition traders. Because an investor usually takes a long-term position, while a trader takes a much shorter term. In either case, the basic concepts and techniques presented in tonight's class are equally adept. Now, one of the most important questions, and people ask me all the time, should I buy this today? What will the price be tomorrow? What will it be next week or next year? Wouldn't investing be easy if we knew the answer to these seemingly simple questions? Sure, it would be, and if we had a magic genie that might give to us our crystal ball, we could maybe just guess at the markets. So alas, if you're attending tonight's class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. Only your crystal ball does. Okay. Now, if you're attending this webinar with the hope that technical analysis will improve your investing and trading, then I have good news for you. It will. But remember, ultimately, the markets are always about money management and risk management. And these are more important concepts than actually technical analysis. Okay. Because entering a correct trade and protecting yourself and finding high probability success trades is more important than just analyzing should I enter or exit a market. Now, the term technical analysis is a complicated sounding name for a very basic approach to investing. Simply put, technical analysis is a study of price, with charts being the primary tool. Now, too many of us mix up technical analysis with what we think are technical indicators. MACD, RSI, stochastics. These are what everybody talks about, and they seem to think that this is the whole world of technical analysis, where it's just a little tiny sector. Now, the roots of modern day technical analysis stem from Dow theory, developed around 1900 by Charles Dow. Now, can you believe that technical analysis was around before there was online trading, before there were CFDs, before there was Forex trading? Okay. It was basically developed for a slow-moving stock market. And most of everything we do can be attributed back to Charles Dow. Charles Dow's contribution to modern-day technical analysis cannot be understated. His focus on the basics of security price movement give rise to a completely new method of analyzing the markets. Okay. He began looking at confirmations, divergence, volume, mirroring changes in price, support and resistance. This was not looked at before. Okay. People would analyze the overall value of a stock. They talk to their friends and neighbors and look at the board of directors. They would trade from fundamental analysis. But it's also, as we've gotten into a much bigger market that is no longer controlled by professionals. And what I mean by what I'm saying this is, when I was younger, and before I actually got into trading in the markets, you basically dealt with a stockbroker who was a highly trained professional, okay, who put his reputation on the line and would help you invest or make recommendations to invest your money in very slow moving markets. But with the growth, and this person, was fairly reliable, dependable, but they didn't know, they had more access to more information, but they didn't know much more than any of us did. Okay. But they were trained professionals. They could sniff out something. They could look at a stock's earnings and they could tell whether the company had a future. But as the markets grew, and as online trading grew, and the investor pool or the trading pool got huge. I mean, I remember my father, and he had lots of stock with his stockbroker. He had no idea what he was investing in because he didn't care. He gave his account, his portfolio to a broker who was responsible for managing it. That's it. Today, we're dealing with millions and millions of human beings from all walks of life that are entering the marketplace and affecting price movement. So the price of security represents a consensus. It is the price at which one person agrees to buy and another person agrees to sell. The price at which an investor is willing to buy or sell depends primarily on his expectations. If he expects the security's price to rise, he will buy it. If the investor expects this price to fall, he will sell it. But these simple statements are a major challenge in forecasting asset prices because they refer to human expectation. As we all know firsthand, humans are not easily quantifiable or predictable. This fact alone will keep any mechanical trading system from working consistently. Because human beings are involved, I am sure that much of the world's investment decisions are based on irrelevant data. Our relationship with our family, our neighbors, our employer, the traffic, our income, our previous success and failure rates, all influence our confidence, expectation, and decisions. Imagine there's a big hedge fund manager or a big currency trader for a major bank, and on his way to work, he gets into an accident. Well, today, because he got in the accident, he arrived 3 hours late for work. He didn't make a couple of those trades that you would have expected him to making, and millions of dollars weren't traded on his desk. Another guy had a fight with his wife, so he was in a bad mood. And granted, they're using black boxes, they're using all types of computers, but it's still that human element, that person at the end is pushing that button to make that trade. So all of this does affect the markets. So security prices are determined by money managers, home managers, students, strikers, doctors, and dog catchers, lawyers and landscapers, and the wealthy and the wanting. This breadth of market participants guarantees an element of unpredictability and excitement. So if prices are based on investors' expectations, then knowing what a security should sell for becomes less important than knowing what other investors expect it to sell for. That's not to say that knowing what a security should sell for isn't important, but in today's marketplace, especially for traders, we're less concerned with what it should be selling for and Really, we're more concerned with what the price action is doing right now. If we determine that Apple stock should be worth 149.95, well, by the end of next week, it might be 149.95. But we only care when we're buying a CFD for Apple is, oh, did it just bump up to 149.40? And do we expect it to drop back down the next hour before it rises back up to what its expectations are? So we're more involved in price action. Now, I hate to ever use gambling when we come to investing or trading. But unfortunately, a lot of new traders, or a lot of existing traders are gamblers because they don't apply any type of analysis. But that's not what I want to talk about right now. Okay. The best analogy I can find on how technical analysis can improve your investing is a roulette wheel. Not gambling, but a roulette wheel. I use this analogy with reservation as gamblers have very little control when compared to investors. But we're not talking about gamblers right now. We're talking about the house. We're talking about the casino, okay, which is like the market or the broker. These are the houses and they have to make money. By moving the odds in their favor slightly, just a wee little bit, they can actually produce a good deal of profit. So a casino makes money on a roulette wheel not by knowing what number will come up next. They could care less what number comes up on a roulette wheel. But by slightly improving their odds with the addition of the 0 and the double 0. So similarly, when an investor like you and me purchases a security, he doesn't know what its price, whether the price will rise. But if he buys a stock when it is in a rising trend with a minor sell-off and when interest rates are falling, he will have improved his odds of making a profit. And this is what technical analysis will help us do. We'll find or analyze price to give us this little bit of an edge in our favor. And that's not gambling, that's intelligence. Yet many investors buy securities without attempting to control the odds. So contrary to belief, you do not need to know what a securities price will be in the future to make money. Our goal should simply be to improve the odds of making profitable trades. Even your analysis is as simple as determining the long, intermediate, and short-term trends of a security. You will have gained an edge that you would not have had without technical analysis. Now, granted, out in that marketplace today, there are lots of automated trading, quants and robots, but you don't hear anybody really telling you they're getting rich with them. Because if we all could find robots who would do all the trading for us, we'd all be using robots and we wouldn't be doing any of our own analysis. But if we accept the fact that human emotion and expectations play a role in asset pricing, we should also admit that our emotions play a role in our decision making. Many investors try to remove their emotions from their investing by using computers to make their decisions. Doesn't work. Mechanical trading systems can help us remove our emotions from a decision. They can help us see a possibility of a trade. But because we're dealing with the human element, that we have to make the final decision on our own. So this is not to say that computers aren't a wonderful technical analysis tool. They are. They are indispensable. In my totally biased opinion, technical analysis software has done more to level the playing field for the average investor than any non-regulatory event. Because you know what? With all of these automated tools, Java charts, HTML charts, advanced trading tools, technical indicators, scanners, guess what? It's put us on an equal level with all of those big hedge funds, those big banks, because we can get all of this data, or our computers can crunch all this data, for it's just as fast as theirs can. Now, this is where technical analysis comes in. Technical analysis is based almost entirely on the analysis of price and volume. The field which defines a security's price and volume we'll explain in a second. But if you stop and think about it, you're either looking at charts, you're looking for patterns on charts, you're using moving averages, you're using our support and resistance, or using technical indicators. Now, what is the data that these are all using? Because they're all using just little bits of data. We're using the open price, the close price. We're using the high and the low. We're using volume. And that's about it. So every indicator and every tool we have are based on these 4 little pieces of information. Now, technical analysis involves looking at patterns and price history to determine the higher probability time and place to enter and exit a trade. Now, one of the most relevant fields of technical analysis, which most newbie traders or most CFD traders ignore entirely, are chart patterns. Chart patterns are actually used more than any of those technical analysis indicators that are just simple mathematical calculations. RSI, stochastics, they're just simple mathematical calculations. But patterns developing on charts are actually showing you the psychology of a market and showing you what to expect and helping you predict what to expect. So things like triangles, flags, pennants, flying saucers, cups and saucers, head and shoulders, channels are ultimately important. And this is one big field that falls into technical analysis. Because basically technical analysis involves anything and everything that's done on a chart. A lot of people just refer to it as chart analysis. Now, as a result, technical analysis is one of the most widely used types of analysis. Since online trading in most cases involves only the major assets, the movement on charts from the price action generally gives clues about hidden levels of supply and demand. Now, because we're trading at short-term basis in CFDs, we're not really looking at the overall supply and demand. Okay. Because we're looking at short-term, and supply and demand doesn't really change in 15 minutes or 1 hour. You know, if we could see how an interest rate increase should support the dollar or support the stock market or will affect the stock market, it might not be visible at today's movement, but we could say the higher the interest rate, we should see the dollar going steadily getting some momentum. We should see gold losing, but not in a one-day trade. This is going to give the dollar overall strength. Okay. Now, technical analysis is a bit of a misnomer since it's really not that technical. A better name for the use of charts to make investment decisions might be risk-reward analysis and even market psychology. Sure, there are some more complex mathematical concepts involved with some of the more esoteric indicators, but at its core, technical analysis is simply a method of determining if an asset is worth buying or selling. Once we identify that we are way ahead of the game with regards to assembling a winning portfolio. So simply stated, technical analysis is a study of data generated from the market and from the action of people in the market. Such data includes price levels that have served as turning points in the past and the amount of stock or assets being bought or sold known as volume, and the rate of change in price movements or momentum over a given span of time. Now, technical analysis also attempts to measure the collective investor psyche, calling heavily on the psychology of crowds and the cycle of greed and fear. If everyone thinks one way, the odds that the market thinks the other is usually high. Now, critics will point out that forecasting future price movement based on past price movement is akin to reading tea leaves or divining the future from the texture of chicken entrails. Well, some of them do. Some say it's like reading a Ouija board. It's alchemy. Now, personally, I believe when you see a triangle developing on a chart, you're not going to be able to predict the movement, but you can see the overall investor psyche and the supply and demand. Now, we may not know if that asset's going to go up or down, but we do know at a given point as it gets to the apex of the triangle, it's going to break out. When it does not break out, whether it's up or down, because we can't necessarily define it, but when it makes that breakout, we can then do calculations using technical analysis to find out how far or how much momentum it has, how far that asset should move in the direction it broke out to, where the next resistance level is, what price was crucial in the past as that asset price moved through those levels. And this is done using technical analysis. But what they do better than most is to make a decision about what to do, buy or sell or hold, based on the probabilities of the actions of others given conditions. In other words, if a pattern on a chart appears, a chart watcher can create a framework for what the market might do if and when the price breaks free from that pattern. It does not work every time, but past performance does give us an idea of what we can expect in the future. So remember, all of this analysis is based on the opening price, the high, the low, and the close. That's it. There's not much else we can do. We're using price. Price is not left up to random. It's whatever that price is. When that price closes in 1 hour, whatever that price is 1 hour from now is what it is. Okay. Now, if you look at a 1 hour chart, where that each 1 hour is important to us. So we have to be able to analyze these markets in some way to make some head or tails sense of it. But that's why ultimately risk management and money management are more important than your technical analysis. Deciding to buy or sell is only your first step. Okay, it's once you decide to buy is what price will you enter the market? What price will you leave the market? What price will you get out? Do you want to be protected from the market moving against you? Okay. Now we can combine this with volume and open interest because we can see if other traders are following along or supporting the movement that we see. So the foundation of technical analysis is the chart. And in this case, a picture is truly worth 1,000 words. Price can be displayed as a line chart, a bar chart, or a candlestick chart. Now, we've talked about patterns. We haven't talked about indicators. And technical indicators are quite important. These are the mathematical calculations that we put on our charts. And now I'm going to run you a quick little video to show you how to do and how to use the charts on the ETX platform and how to put these technical indicators onto your charts. Because knowing how to use them is very important. All right, now that you know how to do them on our platform, technical analysis is the study of historical price action in order to identify patterns and determine probabilities of future movements in the market through the use of technical studies, indicators, and other analysis tools. Ultimately, technical analysis boils down to two things: identifying the trend and identifying support and resistance through the use of price charts and multiple time frames. Because ultimately, markets can only do three things: they can move up, they can move down, and they can move sideways. I mean, technically, if you think about it, that's it. Prices typically move in a zigzag fashion, and as a result, price action also only has two states. Price action is either ranging, and that's when prices zigzag sideways, or they're trending. That's prices either zigzagging higher or lower. If we can determine, number one, if price is moving in any one of these types of markets, and we can find that movement, and then we can identify the momentum or the strength of that movement through trend analysis, we can then move things in our favor. So technical analysis of a market can help you determine not only when and where to enter a market, but much more importantly, when and where to get out. Now, technical analysis is based on the theory that the markets are chaotic. And a lot of you in the class tonight have been trading with ETX for a long time, and probably a lot more of you have been trading for a very long time. And we know that the markets are exactly that. They're chaos. Nobody can really predict what they're going to do. We can hope and we can guess. We can try to analyze them, but they are chaotic. But chaos theory allows us to make some sense out of this. Okay. Now, at the same time, price action is not completely random. In other words, mathematical chaos theory proves that within a state of chaos, there are identifiable patterns that tend to repeat. And chaos theory does not come from the financial markets. Okay. If a lot of us remember Jurassic Park and remember, I forget his name, the tall actor, and that's what he was. He was a mathematician based who used chaos theory for everything. Okay. This type of chaotic behavior is observed in nature in the form of weather forecasts. For example, most traders will admit there are no certainties when it comes to predicting exact price movement. As a result, successful trading is not about being right or wrong. It's about determining probabilities and taking trades when the odds are in our favor. Part of the determining probability involves forecasting market direction and when and where to enter into a position. But equally important is determining your risk to reward ratio. So remember, there is no magical combination of technical indicators that will unlock some sort of secret trading strategy. There's lots of gurus out there that tell you to do this, do that, do this, do that, and you're going to make a fortune. Use RSI stochastics and overlap them with a 6-day, 10-day, 14-day this. And when you get this pattern, make that trade now and you'll make a ton of money. Doesn't happen. The secret of successful trading is good risk management, discipline, and the ability to control your emotions. Anyone can guess right and win every once in a while. But without risk management, it is virtually impossible to remain profitable over time. And this is what I'll keep harping on. Risk management is more important than any type of strategy. So since watching charts is not infallible, and even more important aspects is that we will tell us quickly if our assessment of the market's mood is incorrect. For example, if price moves higher from a triangle pattern in the chart and then falls back within that pattern, we'll know that we were incorrect in our original decision to buy. Either we missed something on the chart or the market simply changed its mind. That's one of the reasons we add volume into our decisions. We sell immediately and book our small loss, leaving our egos at the door. But we got out of a trade without losing our shirt, and that's what's important. Basic chart analysis is rather easy. So let's lay out a set of basic yet powerful tools so that you can perform your own technical tests on a security, which you might be interested in. Okay. While professional technical analysts have dozens, not hundreds of tools at their disposal, it all boils down to 3 steps. Seeing where the security is currently trading, figure out how it got there, and determining the power of the trend and making comparisons among other assets. So we want to look at trends and trend lines. There's no secret to finding a trend. If prices are generally rising and making higher highs as well as higher lows, then we have a rising trend. And knowing that is half the battle. If we're making lower lows and lower highs, then we got a downtrend. Okay. Finding support and resistance. Now, these are terms that simply tell us what price level are likely to bring out the buyers or the sellers. Okay. We can do this using moving averages or volume and momentum to confirm. To do this, all you need to do is have a few key technical tools. Relative performance. These are simple ratios of performance to a relevant markets index or group if you're trading stocks. Okay. Now that we have the theory and the tools, let's look at some processes of going from an idea to an actual decision to buy or sell. So we want to look for a trend. We want to find a rising trend or one that is just starting to rise. Find nearby support and resistance levels, and we are trying to find assets where demand exceeds supply. Okay, these are the first 2 basic steps. Then determine if the current trend is healthy. And this is where technical indicators, as well as trend lines, as well as chart patterns, can come into support. We want prices to be above a relevant moving average, but not so far above it that the asset is prone to snap back and decline. We want to check volume and momentum indicators to see if they are not fading as the price rises. A falling indicator warns that there might be technical problems before price action sours. Once we've done this, if the asset passes all of these tests, we have a candidate to trade, a simple candidate. We're not making a trade decision. We now have a candidate. Okay. And then we can then start applying any type of strategy you might have. And then you have to do the important things. Determine at what price you want to enter the market, what price you're going to exit the market, what price you're going to put for your stop loss, and then how are you going to enter the market? What type of an order you're going to have. Okay. But now you've developed a candidate, and this is what basically technical analysis does. It helps us sort through all the mess and come up with a candidate for a high probability, profitable trade. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. Thank you for supporting ETX, and we'll talk to you again real soon. Have a good night now. Bye.